Should you take the lump sum or the payment for your pension? As with a lot of things in financial planning, it depends. However, there are some very important factors to consider when you're making this decision. Now, as a certified financial planner with over 20 years experience, we come across this question quite frequently. And I think a lot of investors are perplexed as to how they make that decision. Now, for some, that decision is already really made, because if you need the cash flow to sustain your quality of life right when you retire, then you may not have the option. So I'm really speaking to those who have the ability to put off taking a payment right away. So let's talk about the most important factors as I see them. Number one, the tax consequences. Now, if you take a pension as a payment, you are automatically going to be taxed on that income. That'll be added to your adjusted gross income as ordinary income, added to whatever else that you're taking, whether it be Social Security or your taxable gains and interest. Now, if you're under age 65, this can be very impactful because it may preclude you from the ability to get an Affordable Care Act subsidy for your health insurance. That can be a huge factor in deciding whether you want to take a pension as a payment or a lump sum. Another factor as it relates to taxes is the ability to take that money and roll it into an IRA tax-free and then potentially convert it to a Roth IRA. Roth conversion as a strategy to reduce taxes in the future on required minimum distributions is something that we often recommend people take a look at, and can be pretty impactful if you look at this on a spreadsheet down the road for long life. Another factor to consider is the estate value. Now, if you do a rollover into a lump sum, you'll have that money, and if something happened to you or your spouse, this will be part of your estate. On the other hand, if something happens to both you and your spouse, that pension has zero value to your estate. So that's another consideration. The next factor to consider is really just doing the math. This may seem complicated, but it's really not that hard. You take your lump sum amount, the payment you're due, out to your life expectancy. That's calculation one. And then I would do a second calculation for a longer than expected life. So let's use a real life example. The husband and wife are age 62. The husband had an option to get a lump sum payment of $957,039 or a lifetime benefit monthly payment to both him and his spouse. So it's 100% survivor benefit of $4,971 per month, non-cost of living adjusted. Based on the Social Security life expectancy tables that we've listed in the detail below, the husband has a life expectancy of 19.03 years and the wife of 22.04 years. Now, solving for this is fairly simple on a financial calculator. Using that present value of the lump sum and the payment of $4,971 a month out to the wife's life expectancy of 84 years old, you came to a return of 3.03%. So 3.03% is the bogey to life expectancy. So Dwight, what if we live longer than our life expectancy? And we all hope to. Well, in this case, we ran it out for two separate other calculations. We ran it out to 92 and we ran it out to 100 years old. So what does that solve for? About a 4.57% average rate of return to life expectancy at 92. So the longer you live, the higher the bogey becomes. If we take it out to 100 years old, we come to a 5.44% rate of return. So the question that we have to answer is, what are the chances that you'll be able to outperform, whether it be 3.03% or 5.44% over the long haul? So that's another factor to consider. The last factor that we sometimes consider is the guarantees. A lot of folks aren't aware of this, but private pensions, if you work for corporate America, are insured by the Pension Benefit Guaranty Corporation, the PBGC. This legislation has existed for a long time under ERISA, and it protects private pensions from default. Now, we're thankful for that particular program, and I do believe that it will continue to operate, and I don't have concerns that the PBGC will completely dissolve. However, there is concern sometimes that this particular organization, this federal agency, has become underfunded. More importantly, the PBGC insurance is not infinite. For example, when United Airlines went out of business in 2005, a lot of the pilots were under a pension. The PBGC had to come in and insure that pension, but a lot of those pilots had a cut to their pension that they did not expect. So there is a limit on how much the PBGC will insure your pension for. It depends on what type of plan you have. It depends on your age. But if you'll look at the link below, I've put what that pension guarantee is. I hope this has been helpful, and I encourage you to put comments below. If you have any questions on your personal situation and you'd like us to review it, message me at the email below. Please like and subscribe so the algorithm will treat us well. All the best to you. Thanks for watching.